And so now we're really just going to start at the absolute beginning. If you want to trade stock, you have to have cash deposited at a stock trading broker. And I titled this, so I'm going to do a series, or a lecture series. I don't know exactly what I'm going to cover in this video, but I titled it Financial Trading Basics, because we're going to cover all sorts of financial trading instruments, and we're actually going to develop our strategy. That's for sure what we're going to do in this video. But so the first thing you need to do is you need to transfer money to a broker. And there's two differences for a broker I don't say there's only two differences, but there's two differences I care about. And that's the commission cost, and the commission fee is literally how much money you have to pay the broker to execute a trade. And then the other one is the availability of shares. Availability. We'll be covering long and short positions here in the next slide or two, but the availability, I think, is much more important than the commission. TD Ameritrade, I'm pretty sure $6.95 for an equity trade. E-Trade is, I want to say $5. I don't know that for sure. Schwab, I want to say I saw a commercial for $4.95. I do all of my trading at TD Ameritrade. I've heard very good things about E-Trade. Again, I just saw a Schwab commercial, so I put that up there. But frankly, your trading strategy is going to matter a lot more than your broker. As long as we get to, we'll talk about the availability. But then once you have, put your money in your account, now you're sitting there at your little terminal, now you say, what should I trade? And to do that, you need to develop a market strategy. And once you've developed a market strategy, you have to execute a trade. Once you execute a trade, you have to manage a trade. I put discipline and psychological biases as point number 4. These are all the things that I want to try to cover in this first video, but discipline and psychological biases are quintessential to managing a trade. So that's one and the same thing. But I've already covered my returns, but frankly, I don't think your overall returns really, they do matter. I mean, you obviously, the point of stock trading is to make a lot of money. But my point is, I don't think returns or losses really define your capacity to trade, your competence. And that's over the short term. You can have an account that goes up really high, really big, and you make a terrible trade and you lose it, and it's like, are you still a trader? Who knows? So I think what really makes someone a bona fide trader is longevity. You trade in the market for a while, you really truly know how to manage your risk, and you do show profitability. And so that's why I think my biggest credentials, I've never blown up an account. I'm completely self-taught. I mean, I watch YouTube. I highly encourage all of you to watch as many different traders as you can to get as much information as you can, but I've personally never blown up an account. I've managed hundreds of trades, any industry, any market cap. And a lot of people, they'll be like, if you listen to Warren Buffett, he's a value investor. I trade. If there's something moving and I think I can make money on it, I'll trade it. So now we're going to start developing our strategy. The absolute most basic question you need to ask yourself when you're developing a strategy is, why can't you make money in the stock market at all, right? I can log onto my computer and make 1,000% return in 24, 48, 72 hours. How is that even possible? The answer is it's the same. There's one answer, it's demand. The only way you'll ever make money trading is if you buy something before a lot of other people want to buy it, or sell something before a lot of other people want to sell it. Period. That is the only way to make money trading. The next question you should ask yourself is, how much money is in your account? And this will address, or this will kind of limit or enable you to trade bigger board stocks. I mean, this matters on the share size that you can take, but this is where options become very awesome. I had a point for that 1 second. How much money is in your account? Okay, so if you're less than $25,000, then your account cannot be labeled what's called a pattern day trader. This is an SEC regulated thing. So pattern day traders, if you execute 3 or more day trades in a given 5-day trading session week. What is a day trade? A day trade is literally when you just open and close a position in one day. One trading, 9:30 to 4. And that's, if you want to trade a lot, I'm not for or against trading a lot. It really just depends on what's going on in the market. But if you're under $25,000, you will at least, I don't know if the SEC limits the amount of trades you can take in a week. I know TD Ameritrade does, and it's 3. But that, if you're well under $25,000, that's really not, that is not a, it does, I want to say it doesn't matter, but it will affect your approach, but you, by no means to start trading, do you or should you take $25,000? And just to be clear, so what's the difference between a day trade and a swing trade, or just not a day trade? That's when you open and close the position not on the same day. And that's unlimited below $25,000. The next question is, how much money can you risk per trade? So you have some set amount in your account. Now, additionally, getting back to this, if you're over $25,000, I know TD Ameritrade, you can leverage, you can get into a leverage situation. I personally leverage my money. Again, should you leverage your money? Depends on the trade. But I definitely think having the ability to have leverage in your account is obviously a good thing. But how much money can you risk per trade? You have your set amount. And I put per trade in parentheses because I don't necessarily agree with this. A lot of portfolio managers or traders will say, you should never risk more than 1% in your account. I'd say, if you know your trade well enough, you should risk your whole account on that one. And that may sound risky, but again, it depends on your risk tolerance and what the specific trade is. Any given trade, you can log on to CNBC right now and hear people talking about the market. The market is effing huge. So that is too general and vague of terminology for me to even really pay attention to. You simply want to focus on each individual trade. And the last and absolutely most important question you should ask yourself is, how the F do I get rich? This is the point of stock trading. A lot of people will associate stock trading with an identity thing. Oh, I'm a trader. I trade once every day, which again, I don't think you should do that. But you should not. You should know what it is when you get into stock trading. You want to make a lot of money. You want to make it very fast, and you want to do it again. That is the point. And this might seem crude or crass or just frank, but this if you don't go into the market with this mindset, this is when your psychological biases will get out of control. So now we're going to move on. Now we're going to decide, we're going to talk about what's the difference between stock equity and stock options. So directly, what is a share? You literally own part of a company. If you go buy 1,000 shares of Facebook, what value does that bring to your portfolio? Well, 2 things, right? We just said demand changes, right? So you buy a share of Facebook today or 1,000 shares of Facebook. Someone wants to buy Facebook more tomorrow. This stock price is going to go up. Now, if Facebook has a good quarter and they want to pay out a dividend, Facebook can come out and say, we're paying a dividend of 63 cents a share. I'm just throwing stuff out there. And so on the day of the payment, or the day of the dividend payment, if you own however many shares you own, you'll get equivalent to the dividend. Now ask yourself, okay, so if a company pays a dividend, why don't I just go buy all the dividend stocks? Well, because the stock equity price can go down. And if the depreciation of the equity price is greater than the dividend payment, well then you've still lost money. So I've heard people that only want to try dividend stocks, and that's, no. What is an option? And I put, on a stock, you can make money by the stock going up or by it going down. What's the difference? If you take a long position, that is what we just discussed. You buy a share of a company. You short a position, what you literally do is, right, on the last slide we talked about our brokers, brokers. Irrelevant. The broker has a lot of accounts, and so when you short a stock, you are literally selling at the market price. We'll get into order types, but you're selling a share that you're borrowing from somebody else with the obligation to pay that back at some time in the future. So long positions, you own the company. Short positions, you're making money by betting it goes down by borrowing. I would say I definitely am a short bias trader. I like short positions. And that ties into our psychological biases, which we'll get to. Okay, so what is an option? What's the difference? An option is a right. When you own an option, what do you own? You own the right to buy a stock or sell a stock at a predetermined price that you've paid previously. So for example, right now today, if you want to open an option spread and you said, I want to pay, you'll see a bid and an ask, and we'll cover this in the bid and ask, how you actually execute these orders here shortly. And you'll see two prices, which is say 63 cents on the bid, and the ask is, I don't know, 65 cents. And this is what's called the stock premium, or the stock option premium. And these stock options are what's called tied to the underlying. They move based on the share price, but there's just more considerations to them. And those considerations are, one second, I'm just gathering my thoughts. Well, you have time decay, and you have expiration. So when you look at an option spread, this is, when you see the bid, this is what people are willing to pay for that stock option right now today. This is what they're willing to sell that stock option right now today. Saying something else. What was it saying? Oh, what else? What are the, when you look at a stock option setup, what do you see? You'll see the bid and the ask, you'll see the expiration date, and you'll see the strike price. The strike price is what you think the underlying is going to get to. Let's say Facebook is at $100 a share, hopefully soon. No, just kidding. But let's say Facebook's at $100 a share, and you think it's going to go down. So you buy puts. But not only do you buy puts, well, now you have to decide what price you think it's going to get to and what time frame. So if you bought, and again, these are just random, these aren't real options. If you bought the 29 June 19s with the strike of $85, what you've bought, what you think is going to happen is Facebook is going to go from $100 a share to the $85. The strike price is what's called in the money. Once you strike, once your option crosses the price, whether call or put, that is when your right has value now. That's it. Someone would actually execute that. But the way, when you're trading options, the only way, hitting the strike price is not the only way to make money off of the option. Now, the expiration date is literally the expiration of that options contract. Once that day comes, if you have not hit the strike price, it is worth absolutely nothing. So the benefit to owning an option is it gives you a predefined risk at any market cap. If you want to go trade Facebook and you only want to put $100 into the stock, you would buy an option. You know you won't lose more than $100. If you wanted to put $100 into Facebook and you think the company is going to be very good over a longer term, now again, I don't know exactly how far out options contracts go, but Like you could hold a Facebook stock for 10 years. I don't think there's options 10 years out. I don't think there's like options, I don't know, 2 years out. I don't know that, but I don't think so. I would not trade those. What else? What else is I going to say about options? Okay, so this is the next point. What are the important differences between stock equity and stock options? We kind of covered them all. With a stock equity, you own something that is not necessary. They both can go to zero, right? You might say, options for sure go to zero, so a stock equity trade can't go to zero. False. They absolutely can. This is just the way. Would you take an options contract, or would you take an equity position, or would you take both? Really depends on the trade. But these are the basics of what's the difference. And I just wrote again, with equity you own part of a company, with options you own a right that can expire. So now we just need to ask the simple questions of what makes a stock move. I titled this one Demand and Stimulus. So what makes the stock move up? And I have here ST and LT, short term, and that's approximately 8 weeks. That's my estimate. I mean, short term can be shorter, can be longer, again, trade by trade basis. And then long term I have is about over a year. So what makes a stock move up in the short term? And the very professional and super philosophical answer is apes. There's literally a bunch of people like you and me on their computers wanting to make money or managing other people's money, clicking buttons. You see a stock price. Just for time reference, I don't know when I'm going to upload this video, but today is June 19th, 2019, and Roku is a stock that has gone from, I don't know, I think it's $24 was the low about 6 months ago, maybe a couple months ago, to, I think today it's $165. But two things. Okay, so we'll get back to this. No, so these aren't strict bounds. 8 weeks is not super rigorous. 1 year is not super rigorous. What makes a stock move up in the long term? Fundamentals and only fundamentals. And it's really the same thing for what makes a stock move down. Short term, apes. And actually, I would say, we'll get there. And what makes a stock go down? Fundamentals. And so, getting back to the Roku example, this stock is up, like I said, probably 400-500% in 6 months. The only way that ever makes sense is if the only way that stock would never correct if the fundamentals have to be improved upon where they are right now, but the expectation of the fundamentals also have to be improved. And so the reason you might think I'm joking or just kind of being a smart ass, the reason I put apes is because this is true. When you have a stock that appreciates, no one knows what's going to happen in the short term, and it's really think about when you're with your group of friends. They're all doing something, you want to do something. Money managers talk to people. Once a stock appreciates, it's literally like FOMO, fear of missing out. They're clicking real fast. Oh yeah, dude, bid the shit up, go, go, go. And that's not really a dig. That's what I do. That's just what the market is. But now I'm going to give you some examples. I wrote fundamentals. This is a pretty general term. What's a fundamental stimulus that would make a stock go up? This company makes a lot more money some way. And so that's what I'm going to do balance sheets and cash flow statements on a different video. But when the expectation changes, that's really going to be when the short-term movements. This 8 weeks isn't really that relevant. I put 8 weeks up here because I've watched the market for 4.5 years, and this seems to be reasonable. But short-term really just means whenever the expectation changes. But once the company makes a lot more money, they might pay a dividend. They might buy another company. They might when you have a lot of cash, you can do a lot of things. You can basically do anything. So the fundamental stimulus for the up is really building better business, very simply. Now, fundamental reasons for the down, same thing, just the opposite. But these to me are a lot more poignant. A company, let me give you an example. I don't have one off the, actually I think I do. I think HMNY. But really this is, I think it's any pharmaceutical company that, let's say, I think the FDA is, well, depending on what study you're doing, FDA trials can range 5 to 10 years. So if you have a startup company that's raised some money, they've been in the market, they've IPO'd, you can go buy a stock of them. They've been developing this IP, and then bam, the FDA comes out and says, you did not pass phase 3 or phase 1 or phase whatever, now you have no product. So you're going to make more money on the upside when the company's making money, and when the company, there's more ways for something to go wrong than for it to go right. And so the the fundamental stimuli to the downside, court rulings, well, that's also the upside, but I personally play court rulings to the downside more so than to the upside. The FDA trials is a big one for the pharmaceuticals. I mean, pharmaceutical stocks, these biotech, because these are we're going to solve cancer tomorrow. All you have to do is approve our drug. Go, go, go. And if you do, that's truly very fundamental. So that's, those types of stock give you a lot of volatility. But now what's the difference? I wrote, it takes years to build trust, seconds to break it. I put that in quotes because that's your average generic sad person in a relationship. Or, yeah, pretty much any, not a romantic relationship, but any interpersonal relationship. And I wrote that there, I put average person. Because this is how people think. And your behavior affects, or how you think affects how you behave. And so, this sentiment is why I like short positions. It takes years and years and years to build good business and sustain that business. It takes one FDA ruling, one court case, one lawsuit, one competitor coming into the market, and the fundamental reasons to go down are much more. And now, and getting back to the last slide where we had equity, if a long position has no, put infinity here, a long position has no limit to the upside potential, a short position does. Once you go to 0, you can't go lower than that. And that's really, that's why stocks move. Fundamental stimulus and apes clicking buttons. Now we're going to cover valuation and market cap. So first, how do you value a company? They say a company's worth X amount of money, how do they do so? There's no definitive, this is how you define the value of a company. Value cannot be absolutely defined. What there are is generally accepted accounting principles. This is literally a bunch of people say this is how you value stuff. But people are people. So how do you value a company? Well, the thing you have is share structure and price per share. I'll give you an example here in a second. And price per share. And this is how I set up my scans. This is how I assess the market. I don't look at valuation or market cap. What's share structure? Once you IPO, you say, here's how many shares that are going to be in the marketplace for sale. There's what's called the outstanding share size, and it's written like O-S. And then there's the authorized share size. And so if a company comes out and has a billion shares outstanding and 1 billion authorized, the authorized share is the total share count that the company can ever get to. The outstanding share size is how many shares are in the market right now. So if the outstanding share size or the authorized share size is much larger than the outstanding share size, you have a very genuine potential for dilution. If you have the outstanding share size as the same as the authorized share size, the company can't dilute anymore, barring reverse split, but we'll talk about that later. And so the way that the market values a company is price per share simply multiplied by the market cap. Or no. Price per share multiplied by the outstanding shares. So if you have a stock at, let's just keep it simple, $1 per share, and there's 1 billion shares out there, that's $1 billion market cap. Market capitalization. I don't know how to spell it. Who cares? And now the next question let's ask is, what do stocks typically trade at? Okay, Brad, if you can't define value, what does the market typically trade a big board stock at? I just said big board. The way that I scan for stocks and view the market is strictly on a price per share basis. And again, that's because trading patterns doesn't really affect demand changes. The price per share, but a big board stock actually has less room to appreciate than a fractional penny stock. So the 3 scans that I have set up are 0.0001 of a penny to 1 penny. Then I have 1 penny to $1, and then I have $1 up. And we'll talk about why. We're gonna do a bunch of examples, but we're gonna see when you want to trade what. But actually, before we talk about what do stocks typically trade at, the way you value a company, or the way that you understand what stocks you want to trade, read the SEC filings. The vast majority, if you go actually and read these things, you are going to be if you take 100 traders, you're going to be the 1% for sure. And the SEC filing you really want to read are the audited ones. 10K. Every year a company has, what is an audit? An audit is you send your financial statements, you send your gaps to an independent third party, and they assess how you looked at your company. That's what an audit is. And so the benefit as a personal trader, you learn. When you read these SEC filings, you're relying on nobody else's information besides your own understanding. And that is so much more poignant for developing good trades than any stock board talking to the traders, blah, blah, blah. Now getting back to what do stocks typically trade at? I actually don't know, but I guess, because again, I don't, the amount of stocks that I trade, like the FANG, Facebook, Apple, well-known stocks, is I typically do the options on them and not very frequently, but 13 to 15 times EBITDA, or forward earnings. EBITDA stands for earnings before interest, taxes, and amortization. But we'll cover this when we cover cash flow. So, value a company by reading the SEC filings. If I just, yes, reading, wow, scary, do it. Yeah, that's what there's to say about valuation and market cap.